Volkswagen, the second largest automaker in the world by unit sales, has been targeting to surpass Tesla in electric vehicle production by 2025. The company has been investing aggressively into EVs, which is an understatement given that VW has committed an astounding $193 billion over 5 years in areas such as manufacturing, battery production, sourcing of materials, and digitizing its fleet. This is an insane amount of money, more than twice that of the entire company's market cap, in a bid to try and overtake Tesla. However, as we enter the second half of 2023, recent developments reveal a surprising turn of events. Instead of accelerating production and sales, Volkswagen finds itself making the unexpected decision to actually cut back on production, citing customer reluctance to purchase their EVs. Meanwhile, Tesla's electric vehicles, including specifically the Model Y, are smashing new sales records globally, raising major questions about Volkswagen's path to electric vehicle dominance. Elon Musk, on the other hand, has a slew of new products on the roadmap, which could spell further trouble for Volkswagen's future. And before we continue, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and a brand new set of quarterly financial data going back up to 15 years on over 9,000 stocks, and it's all freely available. As a legacy automaker, Volkswagen has actually been doing an impressive job in the electric vehicle space. Although they have an entrenched base of over 100 factories worldwide producing ICE vehicles and parts, Volkswagen is one of the top EV producers in the world, coming in 4th place globally in the full year of 2022. This is extremely important for Volkswagen, as over the next decade or so, the company must transform itself into an electric vehicle company and migrate over its own industry-leading gas cars. VW typically makes close to 10 million cars per year, second only to Toyota, and in some years they've even pulled ahead of Toyota. At least Volkswagen is pumping out EVs, while Toyota is still trying to find its footing in the electric vehicle space. They're also outpacing Ford and General Motors, who have created a lot of buzz but don't produce nearly as many EVs as Volkswagen. That said, all of these large players can fall pretty hard, as they have the most to lose in the race to go fully electric. It's much more difficult to replace 10 million vehicles per year of production going from gas to electric than even the low millions. Tesla, which is far ahead of all the other auto OEMs in EVs, is primed to produce roughly 2 million cars this year. And if the legacy automotive companies fail to transition their fleets from gas-powered to electric vehicles, it could leave them vulnerable to being overtaken by more assertive and forward-thinking competitors such as Tesla and some very fast-moving Chinese players in the space. The paradigm has also shifted not just to EVs, but also to software and connected cars, which poses an even further challenge for Volkswagen, which has outsourced 90% of its software capabilities in the past, while the company is also trying to find a balance between selling profitable gas cars and converting its 100-plus production plants into unprofitable EV makers. There are also internal struggles affecting the future of the company. In a significant development, Herbert Diess, the former CEO of Volkswagen, was ousted from his position in August 2022, 3 years earlier than the end date of his contract. Diess was known for his strong push towards electric vehicles and even brought in Elon Musk, CEO of Tesla, a prime competitor of the company, to hold discussions with Volkswagen's executive teams and try to convince them and help them to make the crucial transition to EVs. This demonstrated Herbert Diess's commitment to embracing EV technology and positioning Volkswagen as the leader in the transition to electric mobility, which would greatly benefit the company as the rest of the industry followed suit. However, despite Diess's efforts, Volkswagen had been facing challenges in its own sales performance. Ever since Diess took over in 2018, VW sales have been on a steady decline, falling from over 10 million to just above 8 million units last year. This obviously puts the company, the owners, shareholders, board of directors in a tough position. On one hand, VW has made significant progress in moving towards EVs, which is going to be the future of the company, albeit the road to get there will be bumpy. But at the same time, there's been a pandemic, supply chain issues, chip shortages, and all these problems over the years that have plagued the entire industry, not just Volkswagen, and so this decline in sales should not be completely attributed to Herbert Diess's management. If anything, the electric vehicle division was doing quite well, arguably the fourth best in the world. Nevertheless, Herbert Diess was forced to step down as CEO and was replaced by the previous head of Porsche, Oliver Blume, which suggests a potential shift in priorities within Volkswagen. Blume's focus appears to be more centered around selling gas-powered vehicles, which contrasts with Diess's strong emphasis on EVs. Now, just this week, Volkswagen announced that they would be cutting shifts and production at its Emden plant in Germany. The reason cited being that the company is suddenly experiencing strong customer reluctance for people to buy their electric cars. This cutback would affect vehicle production of Volkswagen's ID4 and ID7 models, and the company also indicated that 1/5 of its temporary workers would no longer be employed starting in August. The real culprit appears to be a shocking 30% drop in forecasted demand for Volkswagen's electric cars. But this seems to be a Volkswagen-specific problem, as Tesla's Model 3 and specifically the Model Y have been smashing records in Europe and all over the world, as Tesla's sales surged to new highs for the second quarter of 2023. It appears that Elon Musk's price cuts at Tesla have propelled Tesla's sales higher, but have put immense pressure on competitors. For instance, in China, one of VW's largest markets and the largest auto market in the world, Volkswagen has had to discount its ID3 electric vehicle to try and spur sales. They've lowered the price to the China equivalent of $18,000, which is crazy since Tesla is still just handing it to them in China, even with Model 3 and Model Y vehicles that are twice that price. This demonstrates that the Chinese consumer is very much aware of the quality of the vehicles that they're purchasing and shows that Volkswagen may be much further behind than people think. According to Ralph Brandstater, who is Volkswagen's China CEO, the China market is overheating. He says that this high level of discounting being seen in the industry will ultimately harm the interests of consumers. But perhaps instead it will harm Volkswagen because a price war with aggressive discounting is typically good for consumers. But he goes on to say that there are over 120 automakers in China launching about 150 new models of vehicles. And this intense competition is leading to high battery prices and is making them face severe economic pressure. Essentially, manufacturing costs are rising for VW, but they're being forced to lower consumer prices. This might be one reason why the China Association of Auto Manufacturers assembled 16 automakers together to avoid what they call abnormal pricing, even though the pledge was later retracted as it violated antitrust laws in China. It seems price fixing is illegal even in China. But this shockwave in vehicle pricing was essentially started by Tesla, as they shake up the entire industry and weed out the ill-prepared players. While Tesla can lower prices and still remain profitable, other EV makers who were selling cars at a loss have simply moved further into the red. This applies to Volkswagen's EVs, including the ID3, which they were forced to cut prices on, and coupled with a 30% slowdown in forecasted demand, isn't looking so good. Volkswagen's China CEO essentially confirmed this by saying that the company wouldn't chase sales growth as profitability of the business was more important. He says, "We will not engage in unhealthy market competition in order to achieve short-term delivery growth." So it appears that price cuts are indeed unhealthy for Volkswagen, even though the company still moved forward to slash prices on some of its models, sort of counterintuitive to their own words. Interestingly, Brandstater also noted that Volkswagen wouldn't be abandoning the combustion engine as VW plans to launch 17 new ICE models in China by 2030 and very gradually transforming models into plug-in hybrids. This sounds like the opposite of where Herbert Diess was trying to take the company, even though Volkswagen had many obstacles ahead. The current management under now CEO Oliver Blume, however, seems like it's trying to revert back to the norm. This brings into question the company's commitment to EVs and the potential consequences on Volkswagen's future of scaling back production and sticking with gas cars for longer than anticipated. The Chinese market is massive for Volkswagen sales, and China is moving the fastest for such a large market in its shift to EVs. Adding 17 new gas-powered models all the way until 2030 seems to miss the big picture and undermines Volkswagen's own progress in the electric space. In essence, right now, Volkswagen is spending billions, if not hundreds of billions of dollars, to retrofit its existing plants in order to build electric cars that people don't want. And so the company is at a crossroads, since they've waded in halfway and are now contemplating going back. To add to the complexity, Tesla also isn't finished with Volkswagen yet, and certainly isn't backing down. Elon Musk has announced a next-generation platform, which will start production likely by 2025 on new, cheaper Tesla vehicles, making cars at around half the price of the Model 3 and Model Y platform. With Tesla's technology and software advantage, and there are some major ones, including removing expensive rare earth metals from the motors and batteries, they could completely decimate sales with this new vehicle that's in the pipeline. Volkswagen, which obviously knows how to manufacture traditional gas-powered vehicles very well, is struggling to keep pace with Tesla's current lineup, and so a high-quality EV at half the price could spell big trouble for VW, as Tesla attacks their lower-end products which are sold at very high volumes. While Volkswagen is busy playing checkers, Tesla is playing a completely different board game altogether, Monopoly. And so it appears that Volkswagen, which was doing quite well in terms of EV sales growth until just recently, has hit a snag, threatening to send the company 2 steps back, even after all the work that they've done to get to where they are today. So do you think Volkswagen will continue to push hard on advancing their electric vehicles? Or will the CEO direct the company back to focusing more on ICE cars? And was it a mistake for VW to replace Herbert Diess with Oliver Blume? Don't forget to watch my last video on Tesla's latest wireless acquisition. Please hit the like button and subscribe, we would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. By joining us, your support helps us to continue to make great content. Thank you guys so much for watching.